Hi, we are starting with the more of the revision, or I should say the revising the entire economic syllabus. So I would just want to touch upon certain things which we must focus when we are going through the material. I'm assuming that most of you all might have gone through this for at least a couple of times since the exams are very close by. And I will just try to keep the same flow what you see in the material. So the first thing what I want to discuss is that about the elasticity of demand. So what you all need to know about elasticity of demand is when is demand perfectly elastic, when it is perfectly inelastic, and when it is partially elastic or partially inelastic. Now the next thing what I want to touch upon is two different things, which is income elasticity and the cross elasticity. So basically income elasticity is nothing but how the demand changes due to changes or in the income, whereas cross elasticity is something to do with how demand changes due to change in price of substituted goods or the price of complement goods. So with this I would want to discuss two different kind of goods. So the first goods we are going to look at are normal goods and then the given goods. So one must be completely aware that for a given good, as the price of the substitute increases, the demand for the good increases. So that is, it does not go by the normal demand law, and in such a case why it is happening so is that the income effect is dominating more than the substitution effect. Now the next thing what I want to touch upon is that everyone must be very clear as to when is demand perfectly elastic and when it is perfectly inelastic. So for a perfectly elastic demand, the curve would be a horizontal line, whereas for a perfectly inelastic it would be a percent when there is a tax which is levied. So the first thing is you must be aware with what is deadweight loss, and then you should be aware with what happens when there is a tax implied. So whenever there is a tax implied, some of the cost or some of the tax revenue is taken from the buyers and some of the tax revenue is taken from the sellers. Now if the supply curve is inelastic in nature, then the tax revenue from the buyers would be less, whereas the tax revenue taken from the sellers would be more. On the other hand, if the demand curve is inelastic, the tax revenue from the buyers will be more, whereas the tax revenue from the sellers will be less. So this is to do with how does tax revenue impact and what is the deadweight loss. Now one must be very much clear as to what is consumer surplus and what is producer surplus. So basically consumer surplus is nothing but what the consumer is willing to offer and at what rate he is being offered. So if I were to see what would be the consumer surplus, then I would want to show it just. So if I'm looking at the demand curve, so if this is the price which is being charged, then this portion is reflecting or is an indication of the consumer surplus, whereas the below portion is nothing but an indication of the producer surplus. So this should be very clear as to, there should be no confusion about this. Now let me move on. So now let us try to understand what is the difference between explicit cost and implicit cost. So basically explicit cost is nothing but which are measurable, whereas when that means that they can be seen on our balance sheet or in the profit and loss statement. So any cost which you're incurring in reality, that would be a part of your explicit cost, whereas implicit cost is something which is not directly measured, but it refers to the opportunity cost for the firm's equity owner or the firm's promoters. So that's something which you do not see directly in the P&L. However, it is something which must be taken into account when I'm computing the economic profit of a firm. So basically based on the explicit cost and the implicit cost, you have got two different kind of profits. The first is accounting profit and the second being the economic profit. So accounting profit would be nothing but what you directly see on the profit and loss statement, whereas economic profit would be the accounting profit less the opportunity cost of the equity owners. So obviously economic profit has to be always less than the accounting profit. So there have been some concepts which have been tested as to differentiating between accounting profit and economic profit. So one must keep that in mind. Now I'll try to move on and come to the cost curve. So like, what is the relation between cost and the quantity? So fixed cost generally is a sunk cost, and we assume that the fixed costs tend to remain constant. Now just one thing I want to share is that the slides are somewhat very much short and I want to cover all the points. So you might find that there will be certain points which might not be a part of the slides, but they will be obviously aligned, and as we go ahead everything will be in line with what I'm saying. So your fixed cost or the average fixed cost will be something like a reducing curve. So this is nothing but my average fixed cost curve, whereas your variable cost, average variable cost curve will be an increasing curve, which means your average total cost will increase beyond a certain point. Now based on the average total cost curve, I also calculate what is the marginal cost curve. So one must be very clear as to what is the difference between average total cost and the marginal cost. So average total cost is to do with your total cost divided by the units produced, whereas marginal cost is nothing but the incremental cost of producing one extra unit. So it is quite possible that for a certain quantity Q, the marginal cost may be less than the average total cost. However, as the production keeps on increasing, at one point of time the marginal cost will go beyond the average total cost. Now a firm will experience economic losses when the price which I'm charging is less than the average total cost. That means that I'm not able to recover my average total cost, which is the sum of average fixed cost and the average variable cost. And the firm is said to be operating at a shutdown point when the price is equal to the average variable cost. So if the price is going to go below the average variable cost, I'm going to shut down the plant, because it does not make any sense for me if I'm not able to even recover my average variable cost. So ideally, a firm will typically try to minimize the losses in the short run by trying to operate if the price is greater than the average variable cost. So it knows that it is at least able to recover the average variable cost, and it will try its price goes beyond the total cost, which means that if price is going to be greater than the average variable cost, it is able to marginally recover the average fixed cost, though it is not able to recover it completely, because of which it is having some sort of economic loss. Now the marginal revenue product is that quantity, or the profit maximization quantity is where the marginal revenue product equals the price. So by employing one more unit of the input, the firm can increase profits as long as the marginal revenue product is greater than the price, which means that if I'm able to get an amount which is greater than the price, then as long as I'm producing more units, the revenue earned from this input is going to be greater than the cost of the input. Now before we come to the measures of money, I want to touch upon certain things which you might not probably see in the slides, but one must be very clear. So let us try to discuss what are the differences between a perfect competition, a monopoly, a monopolistic market, and an oligopoly. And there are at least 2 to 3 questions which are tested on this. So basically one must be very clear as to, in case of a perfect competition market, the demand curve is perfectly inelastic. However, for all the other 3 markets, that is be it monopoly, monopolistic market, or an oligopoly, okay, the demand will be a downward sloping curve. The next difference is that the product type in case of perfect competition is homogeneous. In case of monopoly, there is a single product, which means there is no substitute available. And in case of monopolistic market or oligopoly, we might see that each firm is producing either differentiated products or they are producing, in case of oligopoly, similar products. Now in case of perfect competition, one must keep in mind that everyone is a price taker, whereas in case of oligopoly, they follow what is the market price. Next, what I want to touch upon is what are the factors that affect the supply function. So basically, we will look at two factors. One would be labor and capital. Now if I were to analyze what are the factors that affect demand for labor and the supply for labor, so one must be very clear as to the demand for labor will be dependent upon how much is the technological improvement which one is seeing. So if there is a lot of technological improvement which is happening, then demand for labor is likely to go down. The next is the price of labor, so or the marginal revenue product of labor. So if the price for labor is going down, then the demand for labor is also going to go down. On the other hand, if the price of labor is going up, then demand will increase. The next is the demand for supply. So now the supply of labor. So supply of labor will be clearly dependent upon what is the wage rate. Higher the wage rate, more number of people are ready to work, which means the supply increases. Next is if the income increases, that means the laborer's income is going to go up, then he has less incentive to work, which in other words means that the supply is going to go down. Now the third point which affects the supply of labor will be how much is the adult population in the economy. So if there are large number of people who are present in the workforce, then the supply is going to go up. So this is to do with the factors which are affecting the demand and supply of labor. Now we'll move on to next we are going to look at is one thing one must remember is that for a renewable resource, that is we are referring to if the resource is renewable like water, the supply is supposed to be a perfectly inelastic function, which means a vertical line, and the price would be determined by demand. On the other hand, for non-renewable resources, that is like crude oil, or let me say something like coal, supply is perfectly elastic, which means it is a horizontal line, and the quantity supplied in this case is determined by the demand. So there have been questions which I have tested for how the supply function would look in case of renewable and non-renewable resources. Now next concept which I want to touch upon is what is economic rent. So when we are referring to economic rent, it is nothing but the difference between what a worker earns and what is his opportunity cost. So if his opportunity cost is, let's say, $10, that is what he feels that he should earn, and if he's in reality getting $15, then the economic rent would be $5. So it's more like the producer surplus which we refer to in the demand supply function. Now we would shift our attention for looking at what are the factors that result in the aggregate demand function. So the aggregate demand function is based on consumption plus investment plus the net exports plus the government spending. So if I were to look at the aggregate demand function, it is nothing but now if the first factor which I want to touch upon is the level of interest rates. So if the level of interest rates go up in the economy, effectively the investments which are going to happen is going to increase, which means your demand must go up. If the inflation in the economy, which is nothing but a factor of how the price is changing in the economy, if the inflation goes up, then effectively your consumption will go up. If there is more government spending in the economy, which means that the government is taking a lot of projects in terms of developing infrastructure, that means again the aggregate demand function will go up. And the fourth being the net exports. So the net exports refers to whatever is my exports minus the imports. So if there is a resultant increase in the net exports, which means that I'm more of an export based compared to the imports I'm doing, then again my aggregate demand will go. How does the short run aggregate supply curve look? This is nothing but my aggregate demand function, and at the intersection of this two is nothing but my so this is my long run aggregate supply curve. So effectively, what is aggregate supply in this case? The amount of goods and services which are produced by the economy. So if there are higher prices, which means the inflation is high, then that means that the amount of supply in the short run will go up. However, its impact on the long run aggregate supply will not be much. So the short run aggregate supply and the long run aggregate supply curves will both shift when either the full employment quantity of labor changes, which means the GDP changes, the amount of capital available in the economy changes, and if there is some technology improvement which results in a rise in productivity of capital or labor, then again the supply is going to increase because I'm achieving higher efficiency. So basically your aggregate demand function, that is, if there is a decrease in the aggregate demand from AD0 to AD1, so this is, let's say, AD0, if the aggregate demand goes down to AD1, that means now there is a disequilibrium. Earlier the quantity which was the output was this GDP. Now the GDP has gone down, which means the economy is now in recession. However, this is like a disequilibrium and this cannot continue for long. So what will happen is that your short-run aggregate supply curve will move down. That is, the short-run aggregate supply will increase and you will come back to your original GDP level. So basically, whatever changes happen, they happen in the short-run aggregate supply based on the changes in the aggregate demand. However, the long-run aggregate supply curve is not shifted as long as the GDP of the economy does not change. Now, this is to do with the relation between aggregate demand and the aggregate supply. So one must be very clear. See, basically I cannot cover all the graphs in this blog or in this session because of the fact that there are a lot of graphs and we may not able to cover the tips which I want to share in, let's say, the 30 or 40 minutes time. So what I'm trying to say is that I'm just touching upon points and one must refer to this in the books, and this is more of a refresher session than going into more of a detailed coaching. Now next, what I want to refer to is that what is the Phillips curve, and there have been a lot of questions which have come in on what is the Phillips curve. So the Phillips curve is nothing but the relation between the real GDP and inflation. So one must be clear that it is not nominal GDP, it is real GDP versus inflation. And you have got two kinds of Phillips curve. You have got the short run Phillips curve and the long run Phillips curve. Where these two curves intersect, that is nothing but the expected rate of inflation. Now inflation can be of two types. Inflation can be a demand side inflation, which you called as demand pull inflation, or it could be of the cost side inflation, which is nothing but the cost pull inflation. So in case of demand pull inflation, what is happening? The prices of goods are increasing basically because there is a higher demand. So why do prices increase? Because first of all, your aggregate demand function is shifting to the right. That is because the demand in the economy is more than the supply. So if I were to see a demand pull inflation, so this is your aggregate demand curve, and this is your short run aggregate supply curve. This is your long run aggregate supply curve. So if there is an increase in the demand, effectively the price initially was P1, the price has gone up because of the increase in the demand to P2. However, it does not stop here. What happens next is your short run aggregate supply curve also goes up. So this is your short run aggregate supply curve because of increase in the price rise. So typically the price rise will not stop at P2. It will go one step ahead and it stop at P3. So in case of aggregate demand, the price rise would have been only moving from P1 to P2, which was purely because of the demand increase. However, in this case, the price rise has been P1 P3, which is nothing but a multiplier effect. Similarly, in case of cost pull inflation, as the name suggests, there is going to be a increase in the cost, which means whenever there is an increase in the cost, the supply will go down. However, in this case, again, the short run aggregate supply will go down. Because of the short run aggregate supply going down, the price will increase in the economy. If the price increases in the economy, the real GDP level has gone down because the supply in the economy has gone down. So to move back to equilibrium, the aggregate demand curve has to move again back to its original level. So this will be the graph for cost pull inflation. So you are standing here somewhere initially. However, due to increased cost, your supply has gone down. So supply going down is nothing but moving to the left, which indirectly means that your short-term price has moved to P2 from P1. However, this is a disequilibrium because this is not the full employment rate. So this is like a economy in recession. So what will happen correspondingly? That your aggregate demand curve will move in such a way that everything converges back to the So basically, if one was to see onion price increase is an example of cost pull inflation, because typically it's not the case that the number of consumers have increased who have resulted in a demand side inflation, but it is purely a cost pull inflation. Now the third or the next thing what I want to cover is the different kinds of unemployment rates. So there are three kinds of unemployment rates. The first being the frictional unemployment rate, the second being the structural unemployment rate, and the third being the cyclical unemployment rate. So the frictional unemployment rate is that where there is not a proper match between the kind of people who want jobs and the employers. So there is a kind of friction which is present, which results in unemployment. The second is the structural unemployment rate. So the structural unemployment rate is to do with people who have got unemployed or people who have lost their jobs. They are not getting jobs because the new jobs demand a different kind of expertise or a different kind of skill set which the unemployed labor does not have. Now the structural unemployment rate plus the frictional unemployment rate is nothing but the natural rate of unemployment. The third thing which I would want to cover is that one must be very clear as to what are the different definitions of unemployment rates. So if one was to ask me that what is the rate of unemployment, then it is the number of unemployed people divided by the number of people in the labor force. Then correspondingly, there is something called as the labor force participation rate, which is nothing but the civilian labor force divided by the civilian population, which is greater than 16 years. And then we have got something called the employment to population ratio, which is nothing but the percentage of working age population who are employed. Now one must have this clarity as to what are the different definitions, because there are questions which test you on the different definitions of employment rate. Next is what I want to touch upon is the Laffer curve. So basically, the Laffer curve is a relation between the tax revenue and the tax rate. So people tend to miss out on what is the Laffer curve. So one might assume that as the tax rate goes on increasing, your tax revenue must keep on increasing. So one must be assuming such a type of a relation. However, this is not the case. The relation is some sort of inverted parabola, which means that up to a certain tax rate, the tax revenue will keep on increasing, because tax revenue is not but directly proportional to the tax rate. However, beyond a certain optimal tax rate, if the government is to increase the tax, then there will be a decrease in the tax revenue. Now this is going to be because people will start invading the tax laws. People will not be willing to pay the tax because the tax rates are very high, which means that on the part of the government, the tax revenue will decrease. So this is called the Laffer curve or the Laffer relationship. Now let us look at the different measures of money supply. So money supply is of two forms, and there are two different measures of money. One is M1 and the second is M2. So M1 is nothing but all the kinds of money which are being circulated in the market. However, it does not include any of the deposits which are placed in banks. So any money which is being rolling in the market and which is not a part of the bank treasury forms a part of M1, whereas M2 will be M1 plus all the other forms of money which are a part of banks. So time deposits, which are nothing but your FDs, saving deposits, which is nothing but the money which is put in your normal bank accounts or your current accounts or the saving account money, and money market mutual funds, which is nothing but the money which is invested by banks in mutual funds. This will not form a part of your M1. However, this will be included when you are looking at M2. So one must have that clarity as to M1 does not include any kind of money which is held at banks, whereas M2 takes into account all the forms of money which are held at banks, including traveler's checks plus the checking account deposits of individuals. Now before I come to the Q&A session, I cannot probably touch upon all the graphs, and the only reason to touch upon whatever we have covered till now is that when one is trying to revise the syllabus, these are the things which one must focus on. So probably the kind of questions which will be tested will be more on aggregate demand and aggregate supply curves, more on the money supply impact, more on the capital market equation. So what is the capital market equation? We have not seen the capital market equation. So capital market equation is nothing but your relation between demand for capital and the supply of capital. So your capital market equation will be nothing but your cost of capital on the y-axis and the demand or the quantity of capital supplied on the x-axis. So there have been questions which test you on the capital market equation, which is the relation between the supply and demand of capital. Now, before we come to some of the question answers, some other things which one must be very much aware of is how does the consumer price index overstate the actual inflation. So if one was to ask me if CPI is a good indicator of the actual inflation in the economy, then the answer would be clearly no. And this is referred to as the CPI bias. Now CPI generally tends to overstate inflation. There are 4 reasons to it. So one could be there are new goods in the economy. So older products have been replaced by newer products, but initially they would have been more expensive. So your CPI would be a bit overestimated. Second, there could be an increase in the price of the product because of an improvement in the quality of the product, which will not be captured by the CPI number. Third, there could be commodity substitution, which means that consumers will increase the purchase of the relatively cheaper good compared to the costlier good. So again, this will not be captured in your CPI computation. And fourth, generally consumers tend to go to malls and they want to purchase things from discount outlets or malls, which means that actually the cost of living has gone down. However, this will not be captured in the CPI. Now, before we come to an end, let's look at the relation between what is the demand for money and the supply of money. So if I were to compare the demand for money and the supply for money, the point at which they meet would be the expected interest rate in the economy. So if there is an increase in supply of money, that means that the interest rates have to go down, or if there is a decrease in the money supply, that means that interest rates have to go up. On the other hand, if the demand for money increases, that means more and more people want money, which means the interest rates will tend to go up. And if the demand for money goes down, that means that the interest rates in the economy will tend to go down. Now, the last thing which I want to refer to is the Ricardo-Barrow effect, and this is one of the things which is missed out by most of the students. So if there is a question which appears on what is the Ricardo-Barrow effect, then basically it refers to increase in fiscal deficit, which will result higher taxes in the future. So moreover, this is something which you clearly observe right now, even with the economies like India or China. So there have been fiscal deficits which are observed by the emerging countries, which means that your next generation will have to pay higher taxes. This is something which is the Ricardo-Barrow effect. Now, what are the sources? If I were to look at the aggregate demand function, then the aggregate demand function is nothing but a combination of consumption plus investment plus the government spending plus the net exports. So what are the sources of investment, or what are the sources of financing my fiscal deficit? So my fiscal deficit or the fiscal needs can be financed through either national savings, either it could be borrowed from foreigners, or it could be from government savings, that is in the form of tax. However, when we are looking at the sources of investment financing, one must have an idea of the crowding out effect. So what is the crowding out effect? The crowding out effect occurs when the budget deficit leads to higher interest rates in the economy and lowers the private investment. So basically, if I am going to have more fiscal deficit or more budget deficit, that means the next generation has to pay more tax to compensate for that. And at the same time, since there is a higher budget deficit, foreign investors will not be comfortable to invest in the economy, since they will be feeling that the government is not doing much and they are just running it on the basis of external borrowings. So this will result in lower private investments. So basically with this, I have tried to cover most of the things which are a part of the CFA Level 1 syllabus. To be honest, most of the things are something which can be explained with graphs, and this is more just to touch upon the topics. Now, one more point I want to cover is on the equation of exchange. So one must have a clarity as to what is the equation of exchange. So basically, money supply in an economy multiplied by the velocity is nothing but equal to the price into the real output or the nominal GDP. So basically, if one wants to calculate the average number of times per year that the dollar is used to buy goods, then that would be nothing but equal to GDP divided by the money supply. And finally, after looking at the equation of exchange, one must also look at the expansion multiplier. So expansion multiplier or potential increase in money supply is nothing but 1 plus cost of drain divided by the reserve ratio plus the cost of drain. So this is nothing but the expansion which will happen in the money supply, because there are questions which have been tested for how much expansion will happen in the economy if the Fed or if RBI were to release some funds or buy some securities. So that will be nothing but a function of this too. So with this, I would now want to get upon to the Q&A session and take upon some of the common questions.
Thank you, Vignesh. That was a pretty informative session. In the meanwhile, before we start off with the Q&A, I would like to conduct a poll just to understand. Thank you, everyone. Thank you for taking the poll. And now Vignesh would resume with the Q&A session.
Okay. So basically, CPI is going to overstate inflation. So for this, I'm mentioning 4 different factors. So CPI is computed on the basis of a common basket. Now there are 4 factors. If there is a commodity substitution, which means that people will want to go for a cheaper good if they find it as a good substitute, probably a costlier good, this will not be captured in the CPI computation. Next would be the impact of other marketplaces, like where there are malls opening or if there are any discount offers coming in, and that means that in reality your cost of living is going to go down, since people will tend to purchase it from shopping malls or discount places. However, CPI will not take into consideration. The third is for new good which is established in the market. When the new good is launched, price is going to be high, which is going to get captured in CPI, which means that it will be overstating it. The next question I want to take over is what will be the proportion of macroeconomics compared to microeconomics. So basically, if I were to split it into a ratio of 75 to 25, so probably you will have 25 to 30% of macroeconomics. However, most of the questions would be based on microeconomics, and in macro, most of the concepts will be on the aggregate demand function and more on the concepts like what is the Philip curve, what is Laffer curve, and what is the relation between supply of money and demand of money. Next would be, so how does increase consumption? So effectively, if there is a high inflation, that means that I'm better off spending the money today rather than keeping it for the future. I will want to consume all the goods today rather than waiting it for the future. For given good, the income effect dominant over the negative substitution effect. Now for slides the difference between accounting and economic profit is nothing but the opportunity cost of the equity owners. So basically, accounting profit is nothing but the actual profit in the financial statements. However, economic profit is nothing but accounting profit minus the opportunity cost of equity. Now this is not something which is captured in the accounting profit, so economic profit has to be less compared to the accounting profit. Next is, what is deadweight loss? So generally markets must function in equilibrium, which means that there should be no loss in the economy. Whatever is the demand, that should be met by the supply. However, fact like price ceiling, that is nothing but the caps on the price, then subsidies and taxes result in a production output which is not optimal. So this results in an output level which is lower compared to the optimal level. So this is nothing but the deadweight loss. So deadweight loss is nothing but the difference between the optimal output and the revised output at which the economy is functioning, and that revised output is because of some factors which are external. They could be either subsidy burdens they could be taxes, or they could be something like price ceilings or price floors, which might be imposed upon by the government. Okay, next is, so let me come back to something on elasticity. So probably the questions which will be tested on elasticity would be more to do with the substitution effect and the income effect. Basically, one must be very clear as to the elasticity coefficient is a positive number, though in reality it's a negative relationship. So normally elasticity will be a number which will be greater than 0. That is, a sign is typically ignored when we are referring to elasticity. So elasticity being greater than 1 is nothing but highly elastic, whereas less than 1 is nothing but towards inelastic. Okay, next question I would want to cover is, okay, Ricardo-Barrow effect. So I have covered as to what is the Ricardo-Barrow effect, and that is something which one must remember, that more and more spending that the government does, which results in a fiscal deficit, that has to be compensated by means of higher tax rates in the future. So which means that if there is an excessive spending done by the government, that means that you will not be at loss, it will be next generation which will be at loss. So that is the Ricardo-Barrow effect. So this is, in case of given goods, I would just want to, as substitution impact increases, there is a rise in the demand of the good, which is abnormal, and this is because of the fact that income effect is more dominant. So this is to do with given goods. So basically one must have that clarity as to the difference between given good and normal goods, and at the same time the difference between ordinary goods and inferior goods. Okay.
Question on triangular arbitrage and crossover rates. So I think that you would want to take up now.
Okay. So basically, what do you mean by triangular arbitrage basically? So if I'm looking at two currency pairs, so let me take upon today's example. So today USD INR is trading at, let's say, 60 rupees a dollar, and Euro is to USD is trading at probably $1.35 per euro. So basically a triangular arbitrage will come in if, by going via this cross conversion currency mechanism, if one can make risk-free profits. So effectively, if today's USD INR rate is 60, Euro USD rates are 1.35, then for there to be no arbitrage, the Euro INR rate should be 60 into 1.35. So that would be typically 81 rupees per euro. If the Euro INR rate is greater than 81 or it is less than 81, then that clearly means that one can make a risk-free profit by going long on the euro or going short on the euro. That is, one will go long on the currency which is trading at a premium, trading at a discount, whereas one will go short on the currency which is trading at a premium. So one can try to look at an example of triangular arbitrage by seeing the three different currency rates: Euro USD, USD INR and Euro INR. Typically the conversion will be such that there is no arbitrage present, which means Euro INR rate will be nothing but simply the multiplication of USD INR into Euro USD. If this does not hold true, then there is arbitrage present. Finally, I would want to take this question: Phillips curve and Laffer's. I'm not sure if it is a part of the Schweser material, but it is. I have gone through the material, and on the last slides, or on the last pages, you will find the Phillips curve. So Phillips curve is nothing but the relationship between inflation and GDP, whereas Laffer's curve is nothing but the relation between tax revenue, tax rate. So this will be a part of your macroeconomics material. So if you don't find it in Schweser, but it is surely a part of the CFA syllabus. So if not, then please go through the handbooks or through the main material. And this is something which is important because there are a lot of questions which are tested on the Phillips curve as well as on the Laffer curve. Now, if one was to understand what is monopolistic competition, and certain times people get confused between monopoly and monopolistic competition. So in case of monopoly, there is only single producer, so he has got all the right to charge what he wants to charge. Whereas in case of monopolistic competition, there are a large number of producers, but each of them is manufacturing a little slightly differentiated product. So in case of monopolistic competition, there will be a large number of independent sellers. However, each of them would be selling a slightly differentiated product. Now, there will be a low barrier to entry because each one of them can come in and come up with his own product. The price commanding power will also be very low because there are a lot of sellers available in the market. The demand curve will be a downward sloping curve. There will be no price discrimination in the market, so it would be a very low price discrimination, because if one was to discriminate in the prices, then one will go to some other seller, and the concentration ratio will be something like 40 to 60%. So your top 4 or 5 firms will be controlling 40 to 50% of the market share. Now, going short is nothing but when you are going to sell the currency or sell the asset, and going long means that when you are going to purchase or going to buy the currency or buy the asset. So I think with this we have covered most of the questions. Any other question? Okay, if one wants to understand or remember the cheat sheet or how one can revise the material in, let's say, a couple of hours, then one must not copy the formula, but one must copy the graphs, because a person who does not have an understanding of graphs in economics is not likely to do much in the exam. So one must be very clear as to what happens when there is an increase in demand, how the curve will move, what happens when there is an increase in the cost of capital, or what happens when there is an increase in the real GDP. So all this is explained much better when you have a good understanding of the graphs. Now I cannot share all the graphs as a part of the revision session because it will be too cumbersome and it is not possible to cover within the time limits. However, I would suggest that everyone has to have a clear understanding of what each of the graph means, and based on the graphs I think most of the questions can be solved. Okay.
Thank you, Vignesh. That brings us to the
One more question I would want to touch upon is what is the difference between monetary policy and fiscal policy. So basically the fiscal policy is decided by the government, whereas the monetary policy is decided by the regulator, which is the banking regulator or RBI, or you would say the Fed. So monetary policy is to do with more on the changes in the money supply. So they tend to control the money supply in the market, which means that they would be taking care of inflation, the level of interest rates in the economy, and so on, the reserve ratios in the economy, the money and the rate at which money can be lent or borrowed from different banks. Whereas fiscal policy is purely to do with what government wants to do in terms of its spending, what government is doing in terms of getting in more investments in the economy, what government is doing in terms of its export versus import policy. So fiscal policy will be purely to do with government spending, taxes, bringing in more investments, FDI policy, and all that would be a part of your fiscal policy. So I think with this we are done.
This brings us to the end of the session. If you still have any particular doubts, you can ask them on our forum. That's on edupristine.com. If you go there, you will have an option of forum. It's for free, so you can sign up, and we have our experts who will be there to clear your doubts. You can attend the rest of the series. It will be tomorrow same time, 8 o'clock IST. Thank you everyone. Thank you for attending the session.